Welcome to Get Me Ready to Buy a Home. Here's our next step on credit. We're going to talk about the different pie chart, and you'll see the chart, of what actually matters on this credit score modeling. So you'll see here that 35% of your credit score generally is on your past credit history. So how's your payments? Have they been on time? Were they late? They look at a long perspective of this and see a track record of how you pay your payments on a monthly basis. So that's 35% of your score of the algorithm. And then 10% is the type of credit you have. What they like to see is one mortgage, one installment loan, 2 credit cards. That's the ideal bucket, but of course people have different ways, different things in their bucket. It really isn't that big of a deal. It's only 10%, but that would be like the perfect thing. 2 credit cards, 1 mortgage, 1 installment loan, car loan. The next thing is 10% is how recent your credit is. Have you opened up any new credit lines? If you open up new credit lines, that might be a small risk, and because it's something new. So if you open up a new credit line, that might be something new, and it's a new risk because we just don't know how you're going to effectively make your payments with more utility or more credit lines available to you. So generally speaking, when you open up new credit lines, your score will drop a little bit. Typically takes about 6 months. After your 7th month of new credit, your score will jump back up. And then of course the longevity, how long you've had history with a certain credit card. So you know, if you've had a credit card for 30 years, say your bank card, and you're in good standing, that's going to bode really well for a high credit score. Now, if you're starting out new and you haven't had a lot of credit, you know, it's going to take a couple years for that 15% algorithm to kind of kick in because they want some history back there. Does that make sense? The main thing that I utilize in mortgages to help generate a positive credit score to increase the score quickly, it has to do with your utilization of revolving credit. So this is how it works. Say you have a $10,000 line of credit available to you on your credit card, and you have a credit balance, you've used up $5,000. So you're at 50% utilization. So just so you get to know how that utilization score is done. So say you have $9,000 spent on a $10,000 limit, you're at 90% utilization. Okay, we got that part? So here's the buckets. This is where you want to be. 0 to 9%, you pay your payments on time, that's going to rate the best for your score. And then it goes 10 to 19, 20 to 29, and they're all the way up, okay? So you kind of, if you have revolving credit and you owe a bunch of money, the best way to improve your score rapidly is to pay down those balances. I've had some people do consolidation loans where they just wrap it up into an installment loan and pay off all the revolving credit, and all of a sudden they jump up 50 points. So things like that can be done. Don't do anything until you talk to a lender and they can review your credit and give you some ideas on how to improve it. You can always go to annualcreditreports.com and you can get a free credit report done. They won't give you a score unless you pay for it, but at least you'll see what's being on your credit report. You'll see what's on there and see if there's anything that shouldn't be on there. You can actually dispute it, and there's a process for that. But anyways, the best thing we can do for you is to get your highest credit score. It allows for better rates generally and better loan programs that might be available to you. So if you have any questions, feel free to email or give me a call. I'd love to help you out. And of course, subscribe, like, and share the video if you enjoyed this. Thank you so much.